Hey guys, how are you? Bit of an interesting day today in the markets. So I'm just slightly red on the day, about 3%. And we'll go over my trades and we'll just discuss anything I think is relevant to today's trading session. So looking at the SPY here, we opened near the highs of yesterday, and SPY did in fact fail to change that hourly trend. Where we on the Qs, for example, we changed the hourly trend and we saw a higher high on the hourly time frame, but it got no follow through and it resulted in basically a failure at this point. So SPY was exactly a double top, and we tried multiple times in pre-market here. We tried again on the open and it got rejected, and then we finally got the bear break below the trading range. That was the first break of the day, and then that pretty much set the tone for the entire trading session, and then it just resulted in the price fading downwards. I traded against the trend once or twice here, and we'll go over that. I managed to hedge my position a couple of times. Definitely need to improve on some aspects of my trade management, definitely. And so I'm developing sort of a hybrid strategy between selling credit in the market and also scalping individual contracts at the same time to hedge my positions. Today, I realized that I can be more precise with where I enter my hedging position. So I entered a hedge and then I canceled the hedge immediately after because the market reversed on me. So I wasn't exactly sure. And that's a tricky thing about a hedge, because when you're in a position and you're hedging against your position, you're essentially establishing a neutral position. But at the same time, it's actually two separate trades, which is a bit of a tricky situation to be in if you've never been in that situation before. So looking at SPY here, TradingView wasn't working in the morning, so that was causing a lot of problems around this area. You can see the bar is kind of missing there. I entered a bullish position at 10:49 a.m., which would have been right here after this, after we got the initial rejection, after the second leg down. So first leg, second leg on the 5-minute chart. And I entered around here, 10:49. So that was a put credit spread. I was short the 248 put and long the 246 put. I collected a credit of $56. And then I actually added to that position again later in the day to improve my cost basis. All right, so generally I was short the 248 puts for the majority part of the day. Now, after we got this bear break, I was saying that I was going to establish a hedge for my position if SPY was going to break the lows. But it didn't work the way I wanted it to, because as you can see, look at how we broke the low. We came down with a bear move, an inside bar, and then we got a bear break, and this bear break went straight into 3 inside bars of a retrace. So that's why it was complicated to hedge against the position. So I know for next time that if I want to establish a hedge against my position, I need to do it where the risk to reward for the hedge is better, because I have to remember that the hedge is just going to be somewhat of a scalp anyways. So once I saw the rejection of the moving average here, that would have been the signal to establish a hedge against the position. And again, it's hard to do that because once you're in a bullish position, you obviously want the market to go in your favor, but you also need to remain objective in the sense that if the market gives a bearish signal, it could be a reason to establish a hedge or a scalp in the other direction of the market, you see? So that's it, guys. Constantly trying to improve every day. Now I entered a hedge right here on this inside bar. That's where I made the mistake. So right on after this bear break, we got that inside bar. That's why I entered a put option, and that was a hedge against my short put trade, essentially. And then I exited it 2 minutes later. So you can see here, right there, SPY 237 put, I bought it at 11.24 and I exited it at 11.25 for a small loss, about $7 loss on that trade. And that's just because I wasn't confident and I realized that I had gotten a bad entry and I wasn't in the mood for the market to go aggressively against that trade to begin with, okay? So I messed up with that hedge. I added again to my short put trade at 11.35, and that would have been right on this bar right here. And obviously in hindsight, that is not right, because we were just coming up for another 5-minute lower high, and then we're lower low and lower low all the way down to the bottom, okay? So obviously this trade was red for the majority part of the day, and I was looking for any sign of a reversal. At 12:20 was when I started to obviously say, okay, if it can't hold 247, I'm out. You know, I'm gonna be. I gotta cut this. I'm not just gonna let this go forever, because I'm short the 248s. At this point, it's in the money, and I'm not gonna be messing around with that trade. But one thing that I did realize is that since my spread was only 2 points wide, I was long the 246 puts. So in the case that I needed to do a sort of acrobatic move with the position, I would cover the 248s and be long the 246s. And that's exactly what I did. So once I saw this retrace up here, the trade was just under break even at that point. but I didn't cover any of it. But what I did was when I saw the second rejection, a retrace, and a bear dump here to change that 5-minute trend back in favor of the bears, that's when I covered the short puts right here. That's where I got tired of it. Once it broke below 247, yeah, 125. So you can see right here, I'll show you the trade. 127, you can see that I bought back my 248 puts. I bought them back at the market price at that moment right there. So at that moment, since I had a spread trade, I was now long the 246 puts, which were close to being in the money because we're breaking below 247. So at this point now I'm becoming a bear in the trade because I'm realizing that, okay, we had 2 rejections at the moving average. I'm going to stay on the bear side of this trade now. I'm going to cover those short puts because I'm not in the mood to be short puts that are in the money expiring the same day anymore. So that was basically my decision that I made, and it ended up being a profitable decision because SPY broke down here. And I'll show you where I sold these 246 puts. I sold the first one at 133, so that would have been just around here. So a few minutes later we got this bear break, so I sold it somewhere on this candle, and then I held on to the other one for a while. As you can see, we got a little bit of a bullish reversal candlestick, but there were a number of things that kept me confident here to stay in the trade. And I'll show you the 2-minute chart there, and there was some really interesting rallies that got sold into. So check this one out. So this is it on the 2-minute chart. This was the bear break where I covered the short puts that I had. Down here is when I covered the long put. No, it was actually more 37. It was right around here was when I covered one long put. I took profit on half that position. And then we had this huge squeeze right here, which I didn't do anything with that option, even though it did decrease in value. And as you can see, this rally got sold right into, and then we got another similar rally, which got sold into even more aggressively that time. So that is just something interesting. But it also signals that shorts are starting to cover, but it's not really changing the trend, because as you can see, these rallies, you'll get a huge rally like this. That's just an opportunity for bears to jump on it because we're not trapping any bears who shorted up here or here yet. Okay, if we were going to start breaking higher, then yes, that's what we got towards the end of the day. We got this rally, got sold right into. This rally, again, sold right into just another lower high. So there's no reason for bears to cover when they see these rallies. In fact, it's just another reason to sell it and short it again. Okay. And I covered the last one down here for some nice profits. So because I held on to that 246 put, I had the ability to bring my net profit on the day back to sort of break even. I ended up with a tiny loss, but that's pretty much it. Covered the last one at a price of 168 at 2:06 p.m. So that would have been right here. And of course we chopped around lower, and I wasn't in the mood to be in the trade after that, because once you start seeing multiple inside bars like this, it's kind of just signaling choppy. And as you can see, we bottomed more inside bars, and then once the buyers were confident with it, they just jumped on it and started the massive short squeeze. This squeeze trapped out anybody who shorted here. Then we had a higher low, and then this squeeze trapped out anybody who shorted here, and then we had the final squeeze near the end of the day. So yeah, I'm not interested in trading the last hour of trading for those reasons exactly, guys. All right, so those are my trades for the day. I'm just red by 3% in the account, so it's really not the end of the world. Lessons you can take out of this is that you definitely should always trade with the trend of the market, okay? Unless there is a signal that tells you not to. I was trading counter trend because I was looking for a reversal after 2 legs down. My error was not cutting the trade once it broke below this area, okay? My error was not also hedging against the trade once it came up here or even here, okay? So the areas to hedge the trade would be at the moving average. So if you're in a bullish position and you're trying to call a bottom, for example, like me, then you're gonna wanna be buying puts to hedge against that position near the moving average, okay? So that was one entry right here. This was another entry right here or here. Again, this was an entry, and this was definitely a good entry because we had a low 1 and then a low 2 right at the moving average. So a bear bar closing below the previous bar, and then a bear bar closing below the previous bar. That's a low 2 right at the moving average. And that right there, again, that's the reason why I covered my short puts, because look, the odds are in favor of the bears at this point, and I am not in the mood to be short puts while the bears have the odds in their favor. So I want to play on the bear team at that point. That's the reason why I covered the puts. And obviously I should have covered them here when it went red against me the first time. but I didn't. And that's the thing with these credit spread trades, is because since there's more leeway in the trade, you can kind of get away with not necessarily stopping out the trade right away. So there's like a gray area there in terms of how far you can keep your stop loss. It's because the advantage is really in your favor when you're short options expiring the same day, especially if the trend is in your favor, because as soon as the market ticks against the option decays significantly. So that's something that you need to be aware of. Anyhow, so that's been my trade review for today, guys. I might do another one if this one wasn't so clear. And if there's anything you didn't understand in this video, please leave a comment and I will try to explain it to you in greatest detail possible. All right, I wish you a great day, guys, and I'll see you next week. Stay in the game. Keep your risk managed.